Seven figures. In today's episode, I'll be providing you all with an update of the three portfolios, starting with the dividend portfolio, then looking at the growth portfolio, and finishing things off with the Bogleheads portfolio, also known as the balanced portfolio. Today's episode should be relatively short because it's just going to focus on giving you all an update and closing things out until the next episode. So with that said, let's head over to the dividend portfolio. Now, looking at the dividend portfolio, we can see from last 2 weeks ago to now, not much has really changed. At one point, the market was doing very well, and this portfolio was all the way down to being only negative 11%. But we had a bad finish of the week, so now we're down 17%. Careful to look at the dividend portfolio. What's helping us not be even further negative is that we've earned $180 in dividends, and our market gains are unfortunately negative 1174, as the market has really gone down pretty significantly in the last 2 months. When we look at the cash balance, I haven't put any money in here this week. These are all actually dividends, and I'll show that to you actually when I finish showing you the rest of the portfolio. So coming down here, want to see what's the top gainers, what's helping the portfolio, what's actually hurting the portfolio. So I'll sort here quickly by gains, and you can see healthcare is up 16%. No surprise there with the current situation in the world. I think we need healthcare more than anything else. Bonds have also done pretty well, being up 12.14%. Obviously, people rushed into safe haven investments as the economy started falling apart and the pandemic took hold. Technology has done relatively well due to the fact that now we're either working from home or we're entertaining ourselves at home with Netflix or other things. So technology has actually done pretty well in this environment, surprisingly. Usually, when the economy turns down, we see tech go down. We see a lot of the high growth companies take a hit. But in this downturn, it's actually been different. The growth companies have actually done well. Now, if we sort by what's holding back the portfolio, you can see here the financials, which I'm a big believer in. I actually did add money to this, to financials. I think about $60 this week. I'll add more. And I'm adding to financials really aggressively in my personal portfolio, my retirement portfolio, because I do think the banks are doing fine. They're going to help us get out of this. Energy is a little tricky. Don't know if I want to touch energy right now, but I would buy a company like Exxon or Chevron. I think they'll make it through this, have really good dividends, and they'll get cash flow. If anything, this is going to help them because some of the smaller players are going to file for bankruptcy. The big are going to get bigger, and we should see this be good for the major players. REITs have done pretty poorly, and I think they're going to continue doing poorly. A lot of people rushed into REITs for the last couple of years, and then consumer discretionary. But a lot of the sectors of the S&P 500 are still down significantly. So this is not a market that's actually doing well. But if you're brave enough, probably a good opportunity to get into financials, get paid right now while you wait for the market to come back. So that's really it for the dividend portfolio. We'll head over to the growth portfolio next, and I'll switch over to that right now. Now, looking at the growth portfolio, you can see that first of all, it's up 35.3%, or the equivalent of about $2,000. The market gains are 1968 and the dividends are around $5. This portfolio is focused on growth, not dividends or earnings like that. And this is not even near the peak of this portfolio, as I've said before in other videos. As you can see here on the graph, when I first started this portfolio, it was $2,000, $3,000. Stopped putting money in there really around December. And it really just took off, right? So from December all the way to around February, what's the peak here? February 19th, it was at $10,800. So it was up to like 65% and dropped all the way down to $6,000 and recovered really nicely to get back to $10,000 earlier this week. before finishing at 9,400. This portfolio is focused on high growth companies, companies that I think are going to be monopolies in their space, which are the best ways to invest. You invest in companies that are going to have monopolistic profits because they won't have to worry about competition and competing away their earnings. So if we look at this and try to rank which, based on gains, where all the gains have come from, you can easily see that Tesla is up 244%, AMD is up 70%, Netflix is up 37%. At one point, this was negative because they reported bad numbers. Microsoft is up 33%, Amazon is up 29%. A lot of these companies have similar traits, right? In electric cars, Tesla is a monopoly. AMD is really taking it to Intel right now and eating their lunch. I wouldn't be surprised if this company starts really growing even faster and getting towards the Nvidia kind of like growth rate. Netflix is a monopoly when it comes to streaming. Microsoft is a monopoly when it comes to Office. Amazon is a monopoly when it comes to e-commerce. Alibaba is basically the Amazon of China. Google is a monopoly when it comes to search. Facebook is a monopoly when it comes to being social media. So these companies all have one thing in common, and that's just they dominate their space really, really well, and they can reap huge profits out of that. When we look at the laggards here, they're also companies that I think have the potential to be dominant in their space. So gene studies and gene therapy, Invitae has got a lead up there, and I think they're going to continue growing it. At one point, the stock was down to $6 earlier this year, and I bought more shares, and it's recovered nicely. Beyond Meat, when it comes to artificial meat, we all saw how artificial milks have actually taken it to the dairy industry. I think Beyond Meat has got a big lead in that space. Even though Cargill and others are coming for them, they're going to continue leading that space. So I'm investing them here, but I might also start adding them to my early retirement account. And Uber, Uber is going to be a monopoly when it comes to car share riding. Lyft is a big player in the US, but when you leave the US, it's all Uber everywhere else. I come to Europe quite a bit, and IRs use Uber. So these are really, really strong organizations, and I'm not surprised that they're doing well during these trying times. So that's really it for the growth portfolio. It's held up really well. You see I got $50 coming in that's going to be invested or is already called for. Well, maybe not. So I'm going to probably look at putting all that into Invitae more than likely, or Uber. So that's really it for the growth portfolio. We'll switch over to the last portfolio, which is the Boglehead portfolio or the balanced portfolio. Now here we are on the Bogleheads portfolio or the balanced portfolio. Starting off with the numbers here, 74.32 is the value of the portfolio. We're down 0.74%, so we're nearly flat, only down about $42.7. Here is where dividends do come in handy. In this portfolio, since inception, we've earned $124 in dividends. The market value is down $167. You subtract those two numbers and we're down 42. So the dividends have been helping to cushion the blow. We can look at the value over time here in our graph, which is I like this about M1 Finance. And you can see how this portfolio started off very small when we started last July, kept adding money to it. But you can see how steady the growth is here. And then I stopped around December adding, and this just steadily started growing there with the market growth. But things kind of flattened out anyway. So you could see dangers were on the horizon, and obviously we started seeing a downturn. The reason why this probably happened is because this portfolio is total world index fund, which includes 7,000 stocks, which captures all the stocks in the world. And outside the US, economies were already experiencing some issues there, so they were already starting to decline. It gave us a kind of a forewarning of what was coming before the big hit happened in the US and you saw the market collapse. It's nicely rebounded recently and gone back up almost to its full value, what it was before. But overall, this is a slow growing portfolio that's going to do well in good or bad times. The reason why is earlier, right around December, these numbers were flipped. So if you hit the returns right now, you can see bonds on top, stocks on the bottom. Bonds up 8.24%, bond stocks are down 9.74%. When I hit this again, these numbers were actually reversed. As late as January, actually the total stock was up 8% and the bonds were down 2 or 3%. So they really balance each other off. It's kind of like the yin and yang portfolio. You know that when one is up, the other one's going to be down and vice versa. So I really like this portfolio. It's done okay. And it's one that I recommend to a lot of people who are starting out investing. But that's really it for today's episode. If you enjoyed the video, please subscribe or hit the like button. Thanks. Have a good day. Bye.